Wow, this is crazy! Welcome to today's Explainer, everyone. We are looking at a healthcare giant that quite literally helped save the world just a few years ago, yet its stock has taken a staggering 22% nosedive over the past 5 years. I'm looking at these charts and I just have to say, what on earth is happening here? If you look at the historical market data, the exact figure shows a 21.6% negative return over the trailing 5 years. The market is aggressively repricing this company. It's a classic case of what happens when a pharmaceutical titan transitions from an unprecedented global emergency windfall back to its traditional business model. The numbers show that the stock is now being evaluated as a value investment rather than the premium growth stock it was during the pandemic peak. Wait a minute, are you saying a company that makes billions of dollars is suddenly just a discount bin stock? That's insane. The data bears it out. To understand this, we have to completely strip away the emotion and strictly examine their balance sheet, their late-stage pipeline, and the mathematical realities of their upcoming patent expirations.
Okay, let's dive into this. On today's Explainer agenda, we have 4 parts. First, the post-pandemic Pfizer issue. Second, a financial and fundamental deep dive. Third, the moat and megatrends. And finally, we'll cover 3 future survival scenarios.
Let's move right into Section 1, the post-pandemic Pfizer issue, decoding the market disconnect. We are seeing incredibly negative news headlines about this company everywhere.
So I have to play devil's advocate here. Wait a minute, doctor. What does that have to do with our stock accounts? If they are pulling in $14.5 billion in a single quarter, how could investors possibly be losing confidence? Why is a revenue giant struggling so badly? Looking at their Q1 2026 earnings release, the $14.5 billion in quarterly total revenue is factual, representing a 2% operational increase. However, the stock market is a forward-looking mechanism. Investors are not pricing in today's $14 billion. They are discounting future cash flows based on 3 specific structural headwinds that are clearly documented in the financial filings.
Oh my God, so what are these headwinds? Break them down for me. The data outlines 3 real causes. First, fading COVID-19 revenue streams. Their vaccine, Comirnaty, brought in just $232 million in Q1 2026, which is a massive drop from $565 million in Q1 2025. Paxlovid fell to $186 million. The market knows this is no longer an emergency product line, but a recurring, moderating seasonal vaccine. Second, the looming 2026 to 2028 loss of exclusivity, or LOE, patent cliff. When major drugs lose patent protection, generic competition enters and drastically reduces pricing power and market share. Third, pressure from heavy research and development and mergers and acquisitions expenditures. They are spending billions to replace those expiring patents, which squeezes near-term profit margins.
Okay, that's way too complicated. Could you give a simple analogy? What is loss of exclusivity really? Let me break this down for you. Think of Pfizer's core business model like a highly exclusive, patent-powered streaming subscription service. They spend billions inventing a unique show, in this case, a new medicine. Because they hold the patent, they are the only ones allowed to stream it, and they can charge a premium price. This generates massive recurring revenue, but the patent only lasts for a set number of years. Loss of exclusivity simply means their copyright expires. Suddenly, generic competitors can copy the exact same show and stream it for free or at a massive discount. To survive, Pfizer must constantly invent new blockbuster shows before the old ones expire.
So what you just said basically means they are desperately trying to invent new blockbuster hit shows before their old patents expire and the generic copycats completely steal their profits. Got it. Now, let's look at the actual math in Section 2, Financial and Fundamental Deep Dive. The number on the screen is $14.5 billion.
Yes, if you look at the Q1 2026 condensed consolidated statements of operations, their total worldwide revenue was indeed $14.45 billion, rounding up to 14.5. Out of this, $8.7 billion came from the US and $5.7 billion from international markets. The data clearly shows that despite the COVID-19 hangover, the top-line numbers remain massive. Their biopharma segment alone pulled in $14.16 billion.
Really? So if the revenue is so huge, why the panic? Digging into the Q1 2026 financial highlights, there is a crucial metric hidden beneath the top-line number. Operational revenue for their launched and acquired products, excluding the COVID-19 products, actually grew by 22%. Products like Padcev, Eliquis, and Nurtec drove this growth. Eliquis alone generated $2.16 billion in the quarter.
Wait. Let me stop you right there. If their non-COVID products are surging by 22% and they have drugs making billions of dollars, they're making good money. So why is the stock price like this? Why is the market going wild with negativity?
It comes down to the revenue mix shift and the scale of the upcoming patent cliff. The market is weighing the 22% growth in acquired assets against the sheer volume of revenue that will be exposed to generic competition between 2026 and 2028. Drugs like Eliquis, which brought in $7.9 billion in 2025 revenues, and Ibrance, which brought in $4.1 billion, will face pricing pressure. The market is skeptical that the 22% growth in new areas can mathematically outpace the massive revenue erosion from the legacy blockbusters losing exclusivity.
Okay, so the market is basically terrified that the new stuff won't grow fast enough to replace the old stuff dying off. But what about their costs?
According to the Q1 2026 earnings call transcript, their adjusted gross margin for the first quarter was approximately 76%. This high margin is primarily the result of a favorable product mix and an ongoing enterprise-wide cost realignment program. They are maintaining strict manufacturing cost controls to protect profitability even as legacy revenues fade.
Okay, so they have a 76% gross margin. But with the stock dropping 22% over 5 years, what is keeping current investors around? Why hasn't everyone just sold off and walked away?
The anchor holding the retail investor base in place is the dividend. Right now, Pfizer is offering a massive dividend yield of 7.25%. Because the stock price has dropped, the yield percentage has spiked. Management has maintained this dividend program intact despite recent challenges, transferring significant cash directly to shareholders while they wait for the pipeline to mature.
So what you just said basically means investors are getting paid a hefty 7% yield just to sit patiently and wait out the storm. All right, let's move right into Section 3, the moat and megatrends. I want to see the irreplaceable weapons Pfizer holds to fight off these generic copycats.
Wow, look at all these pipeline assets. What are we looking at here? This slide represents their economic moat, taken straight from the Q1 2026 pipeline progress document. A company of this scale spends billions annually on R&D to maintain dozens of assets across oncology, immunology, and vaccines. Specifically, the data highlights the PD-1x VEGF bispecific antibody, PF08634404, which has just advanced to Phase 3 for first-line metastatic colorectal cancer, as well as trials for endometrial and non-small cell lung cancer. This is a massive weapon in the high-growth oncology megatrend.
Okay, so they have big cancer drugs in the oven, but when do these actually hit the market and make real money? Show me the timeline.
Let's track the data chronologically. In late 2025, the Vitamax settlement secured vital cash flow. Currently, in 2026, they initiated the Phase 3 program for their PCV25 pediatric vaccine, expanding their pneumococcal franchise. But directly ahead lies the fatal weakness, the 2026 to 2028 major loss of exclusivity window. Management has stated in the earnings call that following this window and assuming pipeline success, they are targeting a high single-digit 5-year revenue compound annual growth rate, or CAGR, post-2028.
Wait a minute. Pfizer just spent a massive fortune buying other companies to fix this, right? Are their massive acquisitions actually working, or did they just burn a ton of cash? The financial statements show that the acquisitions are already generating real revenue. The integration of Seagen brought in oncology powerhouses like Padcev, Adcetris, and Tukysa. In Q1 2026, Padcev alone generated $591 million, up from $426 million the prior year. Adcetris brought in $190 million, and Tukysa $122 million. The strategy is mathematical. Use the balance sheet to acquire established oncology growth drivers to directly offset the revenue lost from fading patented drugs.
So what you just said basically means they bought out other companies to plug the holes in their sinking revenue ship, and it's actually bringing in hundreds of millions. That's a huge deal. Now we reach the most critical part, Section 4, 3 future survival scenarios. I want the bottom line forecast for our retail stock accounts. What happens next?
We have 3 clear scenarios on the board: bull, base, and bear. Correct. We must strictly avoid speculation. These 3 scenarios are derived directly from the clinical and financial triggers detailed in the source materials. The trajectory of the stock will follow whichever set of preconditions materializes in the real world over the next 24 months.
Let's start with the good news. What is the optimistic bull case? The bull case trigger relies entirely on 2 specific clinical successes in the pipeline. First, their GLP-1 weight loss trials for beronatide, specifically the Vesper 4, 5, and 6 studies, must achieve their endpoints and capture a share of the massive obesity market. Second, the oncology pipeline, specifically the phase 3 trials for the PD-1 XVF-GF antibody, must result in regulatory approvals. If these high-profile pipeline hits occur, Pfizer easily offsets the 2026 to 2028 patent cliff and mathematically achieves its projected high single-digit growth post-2028, leading to a significant upward repricing of the stock.
Okay, but what if things go horribly wrong? What is the bear case? The bear case represents the materialization of documented risks. The trigger here is the LOE patent cliff, destroying legacy revenue faster than acquired assets can grow, combined with clinical failures in the pipeline. We have a recent factual precedent for this. Pfizer's Sigvadoc Viudadotin recently failed to meet its primary endpoint in a phase 3 study for patients with lung cancer. If these late-stage trial failures repeat, the R&D billions are essentially written off, future cash flows choke, and the 76% gross margin degrades, forcing the stock price lower.
So a few bad test results and the whole thing could slide even further. Got it. What is the most likely middle-of-the-road base case? Based strictly on current Q1 2026 data, the neutral base case is a managed, albeit slow, transition. The trigger is that the proven 22% growth in acquired assets like Padcev and Nurtec, combined with standard lifecycle management of existing brands, slowly neutralizes the patent losses. It won't be explosive growth, but it sustains the balance sheet. In this scenario, the stock trades sideways, and the massive 7.25% dividend acts as a financial anchor, providing the primary return for investors while the pipeline gradually replenishes the portfolio.
The stock market is a device for transferring money from the impatient to the patient. That famous quote perfectly summarizes Pfizer's current high-yield waiting game for the retail investor audience. You're getting paid 7% just to be patient while they rebuild their pipeline.
So, the crucial question for you at home, are you willing to wait for Pfizer's pipeline to cure its patent cliff? Thank you for watching today's Explainer. We hope this deep dive helped clear up the headlines. Your subscriptions, likes, and supportive comments are a huge encouragement for our Explainer production. Let us know in the comments if you are holding, buying, or folding on Pfizer. See you next time.